Imagine stepping into 1990 when a six-figure salary was your ticket to the American dream. You drove two shiny cars from the driveway, you owned a four-bedroom home, and your retirement fund felt bulletproof. Life moved slower and felt secure. Fast forward to today, and that same income has become the new poverty line. You're on a high-speed treadmill of rent, taxes, and bills, sprinting harder yet getting nowhere. Welcome to the new reality. It's time to change your mindset before the math does it for you. In 1990, the world looked so different. At 35, you could earn $100,000 and feel on top of it all. Mortgage rates hovered around 10%, but homes were cheaper. A four-bedroom house cost roughly $150,000. You could finance two reliable cars without blinking. Grocery shelves brimmed with fresh produce. Filling up a tank of gas was a moment of relief, not dread. By 45, many felt set for life. Pensions promised lasting security. A paycheck meant choices, not compromises. Neighborhoods flourished with backyard barbecues, not foreclosed properties. Retiring early was a real possibility, not a distant dream. Back then, middle class meant stability, independence, and freedom. Every dollar went further, and every ambition felt within reach. Today, that security has evaporated under relentless pressure. In 2026, $100,000 feels like pennies at the counter. The IRS takes at least 25% off the top, leaving you with $75,000 before health insurance. In Miami, the median home price soars to nearly $574,000, and two-bedroom rent averages $24.36 each month. Austin's housing market demands roughly $500,000 for a modest house, and single adults need nearly $98,000 annually just to break even. In Nashville, a two-bedroom runs around $1,730 per month, and homeownership hovers near $545,000. Grocery prices have surged 30% in 3 years. Auto loans now average $700 every month. Utility bills climb. Insurance premiums bite harder, and tax brackets inch upward. You're trapped on a financial treadmill, sprinting faster, yet going nowhere. The dream of owning a home or saving for retirement feels elusive. Every extra side gig just inches the needle. Anxiety creeps in as each dollar you earn slips away to expenses, taxes, and inflation. The math doesn't lie. Your six-figure salary vanished before you even saw the full amount. Are you still sprinting harder and going nowhere? Consider Sarah, a 30-year-old software engineer in Austin. She earns $120,000 a year, a milestone once considered exceptional. Yet she pays $2,500 monthly for a two-bedroom rental. Her car payment alone costs $700 each month. Grocery bills climb relentlessly, and any extra bonus vanishes in tax and cost hikes. Despite a 10% raise over 5 years, her disposable income shrinks. Sarah's story isn't unique. Millions of middle-class workers feel the squeeze. The target of six figures has drifted beyond reach. Work harder all you like, and inflation still steals the spoils. Meanwhile, the ultra-wealthy have quietly exited the hours for dollars race. They know a paycheck acts as a trap in a world of infinite money printing and hidden taxes. Instead of chasing raises, they hunt asymmetric assets, investments promising disproportionate returns with minimal additional effort. These assets shrug off rising interest rates and creeping inflation. They call them AI-driven systems and digital real estate. Picture digital platforms generating revenue around the clock. Think of virtual property that grows apart from physical markets. While you scramble to pay for groceries, billionaires funnel capital into data centers that power artificial intelligence. They cultivate digital soil beneath their fortunes. Industry leaders like Blackstone exemplify this shift, investing billions into AI infrastructure and alternative assets. They are not gambling on volatile stocks or flipping houses. They build scalable systems that multiply value without extra hours attached. Imagine networks of algorithms that learn and sell personalized products. Visualize decentralized landscapes of virtual land that accrue worth in any economy. That is the future of wealth, a future detached from time. These asymmetric assets allow the 1% to decouple income from labor. Their digital real estate harvests value while they sleep. Interest rate changes or tax hikes barely ruffle these models. They invest in growth engines, not gridlocked paychecks. Data from BlackRock indicates that AI infrastructure investments delivered 32% growth last year, even as stocks wavered. In 2021, Blackstone committed over $10 billion to building data centers globally. These centers serve as the backbone for machine learning models that power commerce, healthcare, and finance. They operate 24/7, selling computing power to tech giants and startups alike. Each transaction adds revenue without consuming extra hours. This model scales infinitely, creating self-reinforcing growth loops. Whereas traditional real estate depends on location and age, digital real estate thrives on network effects. Every new user, every new algorithm compounds the value of the entire system. That's leverage in its purest form. Meet Jason, a freelancer in Miami who shifted just $20,000 into a tokenized virtual land platform. He reinvested profits into an AI chatbot service that generates passive income through monthly subscriptions. Jason now collects an extra $1,200 each month without trading a single additional hour. Over 18 months, his small plot appreciated 70%, outpacing local housing markets. His secret weapon? Digital assets immune to local tax hikes and interest rate swings. This isn't luck, it's strategy. But if the 1% can build these engines, so can you. It starts with reframing wealth. True wealth buys freedom, not stuff. It's about acquiring asymmetric assets. Step 1. Education. Immerse yourself in the digital economy. Learn the fundamentals of AI platforms, blockchain, and virtual property. Explore practical courses and communities teaching digital real estate strategies. Step 2. Identify your niche. It could be building AI chatbots that solve specific problems or investing in fractional shares of data centers. Maybe you create an online course that sells itself forever. Maybe you purchase virtual land in a thriving metaverse. Find an entry point that aligns with your skills and passions. Step 3. Build the system. Set up simple automation to scale your idea. Use existing tools to deploy chatbots, smart contracts, or digital storefronts. Invest a small amount regularly, like a monthly plan, to accumulate digital assets over time. Each piece of real estate you acquire or each algorithm you deploy adds a new revenue stream detached from your hours. Step 4. Reinvest the earnings. Instead of spending on depreciating assets, funnel profits back into your systems. Grow your digital soil stronger. Step 5. Diversify. Spread capital across multiple asymmetric assets to mitigate risk and optimize returns. Remember, these steps ignore Fed rate hysteria and tax bracket creep. They focus on leverage. Every extra dollar invested in your system compounds exponentially. While others chase bonuses, you build engines. While they fret over inflation, you harvest returns unconcerned by CPI. They work for money. You empower money to work for you. As you progress, join networks of like-minded builders. Collaborate on NFT real estate deals or pooled AI ventures. Learn from early adopters. For example, data center REITs offer fractional exposure to AI infrastructure, requiring lower capital than direct purchases. These REITs pay dividends, creating steady income streams. Alternatively, acquire virtual storefronts in popular online worlds, renting out space to other creators. Each strategy builds digital soil beneath your freedom. In 2026, digital property will outpace most physical markets. Just as urban land soared in value over decades, virtual land holds similar promise. Platforms track sales data showing virtual land appreciating up to 5 times faster than average residential real estate. Even small parcels in emerging metaverses have doubled in value within months. Your first action could be as simple as setting aside $200 to experiment. Use no-code tools like Bubble or Zapier to automate email funnels. Deploy an AI plugin to handle customer service for small e-commerce clients. Sell your templates on marketplaces like Gumroad. Each sale becomes another building block. Or explore staking tokens in decentralized finance protocols. Even small returns compound. A 1% monthly yield morphs into 34% annually. You don't need a $10,000 investment to start. Consistency wins. Tax optimization plays a critical role too. Digital assets often qualify for long-term capital gains rates, sparing you from the highest ordinary income brackets. Many jurisdictions offer favorable rules on crypto and digital property. Consult a specialist to structure your holdings properly. Incorporate offshore or hybrid entities to minimize tax drag. Every percentage point saved accelerates your climb toward freedom. Always track your key performance metrics. Iterate quickly and kill ideas that underperform. Build a diversified portfolio of digital assets, each performing its own unique function. Over months, you will see the friction of traditional markets fall away. Decision-making shifts from scarcity to abundance. You become the architect of your own economy. Opportunity waits for no one. Every moment you delay, inflation eats another percent of your purchasing power. Look around today, and you'll see the collapse of the middle class already unfolding. It's not a future threat, it's happening now. You have two paths: remain trapped in the paycheck cycle, or step into a new era of wealth defined by freedom and leverage. The road won't be easy. It demands curiosity, discipline, and bold action. But every revolution starts with a single decision. Reframe your relationship with money. Build systems that work for you, not the other way around. Redefine wealth as the freedom you can buy back. The future belongs to those who choose to act, not those who wait. Embrace AI-driven investments and digital assets to reclaim your financial freedom.